year we did that.
Look at this. Not a single shirt. Kill me.
It's my freshman year. We did baseball, softball, like the Halloween. Also a good softball game. Forgot about that. It was a bad day.
Can you all hear me?
Yes.
Yeah.
Sarah, can you hear me?
I can hear you.
I saw your mouth move. Oh, my audio is off. Hunter, both your audio and video are off.
I'm here.
All right. A couple more minutes. People should be joining us soon. While we're waiting, take a look at this PowerPoint. And I know that we talked about the Lewis Nobles fraud. And I think we were just starting to take a look in depth at the Crazy Eddie fraud before we had the break. Does that sound familiar to y'all?
I think so.
We got to the point where he was talking, the auditors were going on lunch and stuff like that with the pretty girls.
Okay, yeah, so we did finish that.
Yep.
We didn't do Enron, so that's where we'll start.
Right. Okay. Go over there with Bailey. You want to be quiet. Talk about listen to Enron. Okay.
Josh has joined us, sort of, no audio or video.
I'm here. I'm trying to get my camera to work. No, that's wrong. There you go.
Hey.
There we go. So we're missing Kaylee and Oscar. Is that it? Seems to me that there were 8 people in the class. Maybe there were only 7. All right, so did everybody see the email that I sent about the quizzes?
Yeah.
Yeah.
Yes.
Yeah, so we had 3 tests remaining that had not been administered yet, and that was test 3, test 4, and the final. And so instead of those 3 tests, I'm going to set up 6 online quizzes. So each of them would be taking about half of the material as the tests had covered. And so as I get each of the quizzes ready, then I will be posting for you a study guide so that you'll know what to study for it. And then you can take it online at any time. I'm going to set up the quizzes so that when each person opens up the test, it's going to randomly select questions from a test bank. So nobody's going to have the same test as somebody else. But all the questions will be of the same general level of difficulty, and they'll all cover the same topics from the study guide. Well, I guess we need to get started on the PowerPoint. So I'm going to try something here. Okay, tell me if you're seeing the laser pointer move on the PowerPoint.
We're not seeing the PowerPoint.
I don't see the PowerPoint.
That's because I forgot to click the share button. Try it now.
Yes.
Yeah.
Okay. All right. So, the Enron and WorldCom frauds are really important ones because they were the main frauds that created, that caused the Congress to vote to create the PCAOB. And I think they, and along with the mismanagement of funds by the executives at Tyco, were the 3 main factors that made auditing become regulated by the federal government. So Tyco was not a fraud as much as it was the misuse of corporate money by top executives. And we'll take a look at that later, but we need to dig in and take a look at the Enron and WorldCom frauds. And as it says in the PowerPoint, they are game changers. They're the main factors that caused Congress to pass the Sarbanes-Oxley legislation and create the PCAOB. We're going to take a look then. The fraud began when the management at Enron wanted to borrow more money, but their debt load was so high that they were going to attempt off-balance sheet financing. And if you can remember back when we looked at the chapter on leases and intermediate accounting, we talked about off-balance sheet financing then. Hold on a second. And off-balance sheet financing is using deceptive accounting tricks to try to hide a company's liabilities. And Enron's gimmick that they used to hide their debt was special purpose entities called SPEs. SPEs were subsidiary corporations created by Enron with a small capital investment from an outside source. And I just realized that on the slides, it doesn't tell you what SPE is, what for. So you might want to write this down, or maybe I'll put it in the chat. Let's see, to do that, I have to find group chat. Okay, so it stands for Special Purpose Entity. Okay, so these were subsidiary corporations that Enron created, but they had an outside source that came up with some of the money that was used to create these subsidiaries. Then the SPE, now that it was a company, owned not completely, but partly by Enron. It would borrow money and then use that money to purchase an asset from Enron. So even though Enron owned the company, it was recording a sale. And as you learned when you took advanced accounting, when you do the consolidations, you're supposed to eliminate that kind of entry, but they weren't doing it because the sale was an internal transaction. So the assets sold to the SPEs were carefully chosen to maximize reported earnings. So now they're doing two different things. They are hiding liabilities in these SPEs, and they're using them to record fictitious revenue. Enron guaranteed the outside loan with pledges of its own stock. The SPEs should have been consolidated into Enron's financial statements. It wasn't done properly. And we talked about related party relationships in auditing. Do you remember what those are? They are transactions that take place between the officers of a company and outside parties that could create a conflict of interest, or between the officers of a company and the company itself, like the corporation lent money to the chief executive officer. Any kind of transaction that creates the potential of a conflict of interest between the company and other parties, or between its executives and other parties. Then Enron employed several tricks to overstate its earnings. It reported profits on the sale of assets to its SPEs, but since it was within the company, it wasn't really income. They also created fictitious accounting reserves to manipulate earnings. They deliberately overestimated holding gains on investments. They had an internal control system that would have prevented some of these transactions, but the top management would simply ignore them when it suited them. Now, Enron had a code of ethics on paper that was actually a fairly good one, but it was only on paper. They actually had a business culture with a goal to make deals at any cost, and the top management intimidated employees by firing anyone who wasn't on board with their schemes. And so people were afraid to criticize what they were doing, and they were afraid to blow the whistle because they could lose their job. Since then, new laws have been created to protect people who are whistleblowers. They didn't have them in place at that time. So if you were fired for reporting what's going on, you might be able to get damages by suing, but you might not. So the fraud unraveled in 2001. Enron kept promising higher returns to investors, but couldn't keep up with their promises. A March 2001 article written by Bethany McLean in Fortune magazine about Enron, and you've all heard of the Fortune 500. Maybe not. I don't see anybody nodding their heads. Okay, so the Fortune 500 would be the 500 largest companies in the country. And so Fortune magazine is the one who goes about ranking them. Bethany McLean, she said that Enron stock was overpriced and famously reported that its financial statements are nearly impenetrable and that it was not at all clear how Enron actually made its money. Enron was involved basically not in the energy business, but in trading access to energy, like selling futures for natural gas and electricity and so on. So they are making deals about which companies were going to send electricity or natural gas where. And Bethany McLean, she was a pretty smart woman. She looked at their financial statements and couldn't figure out how they actually were making any money. Well, part of the reason was that what was reported was not really correct. They were overstating their revenues by huge amounts. In August 2001, as people are beginning to become suspicious about Enron, Sharon Watkins, who is one of their accountants, wrote a memo about her fears that their fraud would be found out. She said, "It sure looks to the layman on the street that we are hiding losses. I am incredibly nervous that we will implode in a wave of accounting scandals. My 8 years of Enron work history will be worth nothing on my resume. The business world will consider the past successes as nothing but an elaborate accounting hoax. It's a bit like robbing the bank in 1 year and trying to pay it back 2 years later. Nice try, but there are probably employees who know enough about the funny accounting to get us in trouble. I realize that we have had a lot of smart people looking at this, and a lot of accountants, including AA and Company, that's Arthur Anderson, have blessed the accounting treatment. None of that will protect Enron if these transactions are ever disclosed in the bright light of day." So I'm going to go back and have you think about what Bethany McLean said. She said that the financial statements were impenetrable, and something that we've talked about in other lectures and courses is that one of the goals of financial statements is that there's supposed to be a clear, transparent window so that people can look into the financial position of a corporation. If it's not transparent, then you can't see clearly what's going on in there. And Bethany McLean said that the financial statements were impenetrable, meaning opaque. You can't see through them at all to understand what's really going on in the company. And here, one of their own accountants is basically agreeing with that. Now, take a look at what she said here, and let's think about what is the ethical philosophy that she's using? Is it egoism, utilitarianism, rights, virtue ethics? What do you think is her perspective on ethics when she's writing this?
Maybe egoism. 'Cause
And why do you think that?
she's incredibly concerned about being found out. And she talks about worrying about that the 8 years would be worth
Yeah.
nothing on the resume.
In the online version of this class, I asked that as one of the discussion questions. And most people look at this sentence here that says, my 8 years will be worth nothing on my resume, and conclude it was egoism. Some people take a look here when she says, get us in trouble, and they think it could be some kind of duty she feels to the company. That's possible, but I think egoism is really the more likely one. She's worried about what's going to happen to her. She doesn't seem to have any concern about the people who would lose their investments if the fraud is uncovered. So by December of that year, Enron filed for bankruptcy. And by now you've all had, I think, Business Law 1 and at least a good portion of Business Law 2. In that course, do you look at the different kinds of bankruptcies?
I think that'd be more our fraud class than law.
Okay, so the legal code has different kinds of bankruptcies. Basically, when a company files for bankruptcy, most of the time it means that they're insolvent, they can't pay their bills and liabilities that have come due, and therefore a court is going to decide how to pay back as much as possible to the people that are owed money. Sometimes bankruptcy involves closing the company and selling off the assets to pay the debts. Sometimes it just makes the creditors wait for a while, hoping that the company can recover. And other times the court will give them a certain percentage of the amount that's owed to them. Like if you had a bond of $1,000, you might get back $250 depending on how much they can pay. Sometimes they describe that as pennies on the dollar. So investors suffered $50 billion in total losses because the stock price of the company collapsed down to pennies. And the pension plans of former Enron employees, which had been invested in Enron stock, were completely destroyed. So one thing you would want to look at when you get a job in your career is if you have a pension plan, where is the money being invested? You wouldn't want it all invested in one single company because that's too risky. It should be a diversified portfolio. So Enron's former vice chairman, J. Clifford Baxter, committed suicide on January 25th, 2002. Kenneth Lay, Enron's founder, was convicted of 19 counts of conspiracy, fraud, false statements, and insider trading on May 25th, 2006, but he died of a heart attack before he was sentenced. Former CEO Jeffrey Skilling was convicted and sentenced to 24 years and 4 months in prison. And several other Enron fraudsters were also sentenced to various terms in jail. Auditor complicity. The relationship between Enron and its auditor, Arthur Andersen, was not really one of independence. Arthur Andersen was deeply involved in management consulting with Enron and considered Enron as their customer. And Arthur Andersen began shredding its documents related to Enron in October 2001 as the fraud began to be, it was beginning to be discovered at that time. And so there's a cartoon here about that. The guy looking for a job says, "I see from your resume you spent 5 years with Arthur Andersen," because his resume is shredded. Questions or comments so far? February 2nd, 2001. One of the accountants at Arthur Andersen, Michael Jones, wrote, "Ultimately, the conclusion was reached to retain Enron as a client, citing that it appeared that we had the appropriate people and processes in place to serve Enron and manage our engagement risks. We discussed whether there would be a perceived independence issue solely considering our level of fees." In other words, would people think that they're not independent because they are making so much money from their consulting fees? We discussed that the concerns should not be on the magnitude of fees, but on the nature of fees. We arbitrarily discussed that it would not be unforeseeable that fees could reach a $100 million per year amount, considering the multidisciplinary services being provided. Such amount did not trouble the participants as long as the nature of the services was not an issue. So they were thinking people might think they're lacking independence, but they thought even if we're getting $100 million off of them a year for consulting, we're still really independent. Before I move on to Bernie Evers, any questions or comments then on the Enron? This fraud took place in 2002, just a few miles from our main Belhaven campus in the Jackson suburb of Clinton. WorldCom built a big headquarters there. When they went bankrupt, it was sold and purchased by the state government, which is now where the state government has its revenue authority. I forgot what they call it. Mississippi Department of Revenue, that does the state income taxes, is located there. WorldCom executives effectively fudged the company's accounting numbers, inflating the company's assets by around $12 billion. The swift bankruptcy that followed led to massive losses for investors. Furthermore, this fraud is regarded as one of the worst corporate crimes in history, and several former executives involved in the fraud face criminal charges for their involvement. What did they do in the fraud? Expenses were capitalized to reduce expenses, that is, to reduce the amount of expenses reported on the income statement. You recall from other accounting classes that when a company is making an expenditure, they have to determine the proper accounting treatment as being either capitalizing it as the purchase of an asset or expensing it. And there were expenditures that they're making that should have been recorded as expenses, but they recorded them as assets. And that would decrease the expenses on the income statement and thus increase their net income. The entries were made by top executives in order to bring reported earnings into line with the forecasts made by Ebers. Ebers was obsessed with making WorldCom stock prices rise. So what they've been doing is each quarter, WorldCom was making a prediction of what their net income would be in the next quarter. And if they didn't achieve it, they simply made up entries to increase their reported earnings to the forecasted amount. How they were caught. Cynthia Cooper, WorldCom's Vice President of Internal Auditing, noticed some weird entries in the books and tried to investigate. But, as she told an interviewer, the more we investigated, the stranger the reactions from some of our colleagues became. No one would give us a straight answer, not even the Arthur Anderson partner in charge of WorldCom's audit. Her persistence, along with that of her staff, finally forced top management to come clean. I want to point out that at that time, Belhaven had an adjunct accounting faculty member who taught a night class occasionally. In 2002, she had a nervous breakdown and stopped teaching for us in the middle of a semester. And I think that's because she had discovered what was going on. She was afraid to report it and just couldn't handle the pressure. WorldCom's founder and former CEO Bernard Ebers was sentenced to 25 years in prison. Former Chief Financial Officer Scott Sullivan received a 5-year jail sentence, which would have been longer had he not pleaded guilty and testified against Ebers. The motivation seems to have been Ebers' greedy desire to increase the value of the WorldCom shares he owned. A corporate culture similar to that of Enron, in which many employees were intimidated into going along, was also a factor. Arthur Anderson was deeply involved with WorldCom both as an auditor and as a consulting firm. Their involvement in $2 billion frauds in 2 years, Enron in 2001 and WorldCom in 2002, was the firm's death knell. And a couple of years after that, the only employees left at Arthur Anderson were their lawyers fighting the lawsuits. Okay, questions about the WorldCom fraud before we move on to Tyco? The CEO of Tyco, Dennis Kozlowski, and the CFO, Mark Swartz, were accused of stealing $170 million from the company itself by using corporate money for their personal expenses and of reaping $430 million more by covertly selling Tyco stock while artificially inflating the value of that stock. An article about this said, there's no denying Kozlowski led a lavish lifestyle. His $30 million New York City apartment was allegedly paid for by the company. The shower curtains alone, it was revealed in court, cost $6,000. Now, I get my shower curtains from Dollar Tree. I don't need 6,000 of them. Tyco also footed half of the $2 million bill for an extravagant birthday party for Kozlowski's second wife in 2001. Disguised as a shareholder meeting, it took place on an Italian island. The bash became known as the Tyco Roman Orgy. Kozlowski was accused by investigators of borrowing millions from Tyco. The loans were later forgiven and were never discussed to shareholders. So what is the principle of reporting to the SEC that's being violated by that? That's a related party transaction. And the SEC requires it to be disclosed. He quietly put his doctor and fitness trainer on the Tyco payroll, along with his yachting expert and his chef. Tyco's board was packed with insiders and directors who had questionable financial dealings of their own with the company. Both Kozlowski and Swartz were convicted of grand larceny and conspiracy, falsifying business records, and violating business law. Kozlowski was sentenced to 8 1/3 to 25 years in prison and fined $70 million. Swartz was also sentenced to 8 1/3 to 25 years in prison and fined $35 million. They were also ordered to return another $134 million to Tyco. Their motivations. Greed and hubris seem to be the motivations. Is hubris a word that you've encountered in your other classes? It means kind of like excessive pride and basically a cocky, egotistical attitude about yourself, arrogance. The two executives seem to have felt entitled to their takings, and the corporate culture of insider transactions was also a factor. Okay. Comments about that? Something that you might find interesting is go to YouTube if you have time, or do a Google search for images and find pictures of the Tycho-Roman orgy. It was amazing how much money they spent. I mean, $2 million for Kozlowski's wife's birthday party, and he billed it all to Tyco because they had a shareholders meeting on the island at the same time. Okay. Next major fraud is Bernie Madoff, which it's kind of a funny name because Madoff made off with investors' money. I think a couple of you used this fraud for your term paper.
I did.
Yeah.
I did too.
Madoff had tricked investors out of $64.8 billion through the largest Ponzi scheme ever. So what's a Ponzi scheme? Charles Ponzi was a scammer in 1919, so they're named after him, and it's a fraudulent investing scam promising high rates of return with little risk to investors. Ponzi scheme generates returns for older investor by acquiring new investors. So if you are at the bottom of the pyramid and came in early, then you start getting high yields, but the money you're getting is not actually from an investment's capital gains or dividends or interest. It's money that's being paid in by the new investors. And the money that they think that they're investing is actually not being invested at all. So this scam actually yields the promised returns to early investors as long as there are more new investors. And these schemes usually collapse on themselves when new investments stop. Enron had essentially operated as a Ponzi scheme while it was growing. So who are the culprits? Bernie Madoff masterminded the scheme. In the recession of the early 1990s, he didn't want to disappoint his investment clients with lower returns than they had been promised, so he cooked up this scheme. He pleaded guilty to 11 federal felonies, including securities fraud, wire fraud, mail fraud, money laundering, making false statements, perjury, and making false filings with the SEC. He was sentenced to 150 years in prison. That's his mugshot. David Freeling was the investment firm's auditor. He pleaded guilty to charges of securities fraud, aiding and abetting investor advisor fraud, and 4 counts of filing false audit reports with the SEC. He was sentenced to 1 year of house arrest and 1 of supervised release. Freeling rubber stamped whatever Madoff gave him. He was himself defrauded and victimized. He placed his own family's savings, including college savings, into Madoff's business, and his son, a medical school student, committed suicide in 2012. Madoff said that Freeling was a dumb auditor. Freeling responded by saying, "I would rather be regarded as dumb than crooked. I did not question what I should have questioned." So maybe he was dumb, but when he simply signs off on whatever Madoff gave him, that actually in auditing is criminal negligence. Frank D. Pascali was the investment firm's CFO. He pleaded guilty in 2009 to 10 felony counts, including conspiracy and tax evasion, and was out on bail awaiting a sentencing hearing in May 2015 when he died of lung cancer. He was facing up to 125 years in prison. Peter Madoff, a lawyer, was Bernard Madoff's brother and the chief compliance officer at the trading firm. Do you all know what a compliance officer is? The compliance officer is a corporate lawyer who's in charge of making sure that the company is complying with regulations. He admitted to a range of crimes, including falsifying documents, lying to securities regulators, and filing sham tax returns. In 2012, he was sentenced to 10 years in prison and to forfeit $143 billion, which apparently included both investors' losses and punitive penalties, which I think is kind of pointless because who's got that money? I mean, nobody has $143 billion. How the fraud was uncovered. I set this up for 40 minutes, so I'm going to finish this right now. And I have started making plans about how to do the quizzes. Let's see if I can, no, I closed it. So I will be emailing to you more details about how we'll do the quizzes. So instead of the 3 tests, it'll be 6 quizzes that you take at your convenience. So do you all have any questions before this cuts off? All right. Make sure that you check daily Canvas for announcements and check your student email. If you have questions and need to contact me, do it by email because Canvas can take a while before it tells me anything.
Got it.
Good to see you all. We'll see you again on Friday.
Thanks.
Okay.
All right.
Bye now.